Welcome back to Talk Tickers. It is Tuesday, January 27, 2026. Today, we are turning our attention to Dallas, Texas, to break down the Q4 2025 earnings call for Triumph Financial, ticker TFIN.
And we have to talk about the vibe down there.
We do, before we even get to the numbers.
Right. So you've got the management team in Dallas, and apparently the weather decided to match the trucking economy. It's freezing, it's icy.
Slick roads.
But, to their credit, the management team actually made it into the office to deliver the news.
They showed up.
Yeah.
And looking at these headline numbers, they didn't just show up. They really performed. This was a classic case of, well, the numbers beat, but the narrative is debated.
That is putting it mildly, yeah.
I mean, we're looking at stock that gapped up more than 6% in the pre-market.
Huge move up.
Only to turn around and close down 7% by the end of the day. That is a massive intraday swing. We're talking about a company that absolutely crushed earnings estimates during a, quote, historical freight recession.
And the market punished them for it. It really raises the big question we need to answer today. Is this a harvest story, where a fintech is finally cashing in, or is this just a cyclical trap where the market just refuses to pay up?
Exactly. So just a quick housekeeping reminder before we dive in. We're here to state the facts and ignore the noise. Most importantly, this is not financial advice. We're just here to learn.
Okay, so let's get into those numbers that cause all that initial excitement.
Right. The headlines were a blowout. I don't think there's another word for it.
No. JAP earnings per share came in at $0.77. Now, to put that in perspective, the consensus estimate on Wall Street was just $1.30.
That's a 156% beat. In banking and fintech, you usually beat by a penny or two, maybe 5 cents if you had a great quarter. You don't.
Yeah.
You just don't beat by more than double the estimate.
Precisely. It's so rare. And the top line looks good, too. Revenue hit $120.08 million versus an expected $110.71 million.
So that's up 16% year over year.
Yep. So if you're an algorithm reading that press release at 8 a.m.
You're buying the stock.
Immediately. And they did. The stock shot up to around $75. It really looked like a victory lap.
But then the opening bell rings, humans get involved, and the whole mood shifts. By 4:00 p.m., TFIN is down 7.2%, closing at $65 and change.
And this wasn't on light volume either. This was heavy selling, nearly 1.7 times the average.
So why? Why do you sell a company that just delivered a monster beat like that?
Well, to understand the sell-off, we have to go beyond just the EPS number. We have to look at the three distinct engines of this business. You have the crown jewel, the legacy business, and then the new guy that's costing them money.
Okay, let's start with the crown jewel. This is the part of the story that's supposed to get that high valuation multiple, right? We're talking about the payments network, specifically TriumphPay.
Right. For those who aren't in logistics, TriumphPay is trying to be the Visa or MasterCard for the trucking industry, the payment network.
And management is saying this network effect is finally taking hold. They announced some really serious wins on the distribution side. They added BlueGrace,
which is a big player.
But the one that really jumped off the page for me was J.B. Hunt.
That's a massive validator. J.B. Hunt is a titan. They're one of the most sophisticated logistics companies in the world.
And they build everything themselves.
Exactly. A company like J.B. Hunt usually builds their own tech. For them to say, no, we're going to use TriumphPay, that signals the industry standardizing on this platform.
They threw out a stat that really illustrates this. They now serve 67 of the top 100 freight brokers.
And 8 of the top 10, that feels like critical mass.
It does. But, okay, here's the nuance, and this is where the deeper analysis matters. For a long time, the criticism was, okay, you've got the logos, you're processing billions, but are you making any money on it?
Vanity metrics versus sanity metrics.
Right. You can process payments for free all day long.
And this quarter, the data showed a real pivot. They track a metric called payment fee percentage. Basically, the percent of transactions where they actually charge a fee. In Q4, that jumped from 31% to 35%.
Wait, a 4-point jump in one quarter?
Yeah.
That seems huge.
It is huge. And management pointed out that in December specifically, it hit 38%. So this tells us the repricing strategy is working. They're telling customers, we provide value, and now you have to pay for it.
And customers are paying, and that flows straight to the bottom line.
Correctly. Core payments EBITDA margin hit 29.5%. Management is guiding for that to break 30% in Q1, and they still have that long-term aspiration of 50%.
Okay, so let me play devil's advocate. If the network is growing, margins are expanding, they're signing giants like J.B. Hunt. Why did the stock drop 7%? Is it the other parts of the business?
Partly. Yeah, it brings us to the second engine, the factoring business.
Okay. For anyone who might not be deep in logistics finance, let's define that. Factoring is basically when a trucker has an invoice for $1,000, but they need gas money today. Triumph buys that invoice for, say, $970, gives the trucker cash instantly.
And then Triumph collects the full $1,000 later. It's high-interest short-term lending. Now, there's been this fear that factoring is a dinosaur business, that it's going to die out.
Is it dying?
The numbers say no. In fact, if it is a dinosaur, it's a very hungry one. Revenue in the factoring segment was up almost 6% quarter over quarter.
Oh.
Purchase volume, so the total amount of invoices they bought, was $3.1 billion. That's up 13.5% year over year.
Wait, up 13% year over year? But we're in a historical freight recession. If there's less freight moving, how are they finding more invoices to buy?
That's sales execution, market share gains. But what impressed me more wasn't the volume, it was the efficiency. The pretax operating margin in factoring hit 32.6%.
That seems incredibly high for what's usually a paper-heavy, people-heavy business.
It is. Management credits this to AI and automation. They're processing more invoices with fewer humans. They even did some headcount reductions in late 2025. They're just getting leaner.
They also mentioned some specific cost savings that I found. Kind of symbolic. They sold a building and a corporate airplane.
Nothing says we're focused on efficiency, quite like selling the corporate jet.
Right. It saves about $6 million a year, and they said that's already baked into their 2026 guidance. So, okay, we have a profitable, growing factoring business and a booming payments network. I'm still struggling to find the reason for this sell-off.
Well, now we have to talk about the new guy, the drag on earnings. This is segment 3, LoadPay.
Ah, yes. They introduced David Valier on the call, the new president of LoadPay.
And they made a joke about forcing him to wear a tie because he's the rookie. A little corporate hazing, you know?
So what is LoadPay, and why is it making investors so nervous?
LoadPay is their attempt to create a digital wallet for the trucking industry. So imagine a trucker gets paid instantly into a LoadPay account and then uses that same account to buy fuel, pay for insurance.
It keeps the money inside the Triumph ecosystem.
Sounds great in theory.
In theory.
In practice, right now, it is a money pit. The revenue exiting Q4 for LoadPay was only $1.5 million annualized.
For a company this size, $1.5 million is basically a rounding error. It's a coffee budget.
Correct. But the expense to build it, to market it, to hire teams for it, that's all real dollars. It's a significant drag on current earnings.
It's the classic innovation dilemma. You have to spend to build the next growth engine. But in this market, which is terrified of a recession, investors want cash today, not a promise for a wallet 3 years from now.
Exactly. And speaking of being terrified of a recession, we have to look at the macro backdrop. This is probably the real culprit for the stock drop.
Yeah, listening to the call, it did not sound like sunny skies in Dallas.
No. Management was very blunt. They are assuming the freight market remains flat in 2026. They kept using the phrase historical trucking recession. They are not pricing in any kind of recovery.
And that's a tough pill to swallow. If you bought TFIN hoping the freight market would bounce back and lift all boats, management just told you, don't count on it.
Right. And their 2026 targets reflect that caution. They're looking for a baseline earnings run rate of about $1 EPS, which is good, but it's not explosive growth.
And they warned about Q1. Q1 is always the worst quarter in trucking. Freight just slows down after the holidays. So they told the market to expect a decline from these Q4 highs.
So let's put it all together. You have a massive earnings beat, but you have a management team saying, the economy for our customers is still broken, and oh, by the way, we're going to keep spending on this new product.
That's the conflict. It's a conflict between the harvest and the cycle.
Explain that.
Management called 2026 a harvest year. They believe they've planted the seeds, the tech, the network, the repricing, and now they're going to reap the margin expansion. They think they can grow earnings even if the freight market is dead.
But the market disagrees.
The market looks at the valuation. TFIN trades like a tech stock, not a bank. And to justify that price, you need growth. The market worries that if trucks aren't moving, Triumph eventually hits a wall, that the bridge to that 50% margin goal is just longer and more expensive than the beat suggested.
It's like the market is saying, we don't believe you can defy gravity forever.
Right. If your customers are going broke, eventually that has to hurt you.
Yeah.
It was the perfect sell the news dynamic. The stock was up coming into the print. They heard the grim macro and they took their profits and ran.
You know, before we move on, we have to mention the highlight of the Q&A.
Oh, the technical difficulty.
Yeah.
It wasn't a financial metric.
The attractive dogs moment.
Yes. Donald Broughton, a well-known analyst, tries to ask a question. But instead of his video feed, management just saw a video of, I quote, two attractive dogs.
I think someone corrected it to horses later, but honestly, in a dense financial call, you need a moment like that.
It does bring up a good point, though. Credit. When we talk about risky bets, we have to talk about the risk of truckers defaulting.
Which is a perfect transition to our final segment.
It is time for. This is not financial advice.
Sure.
This is where we pitch a trade idea that is outrageous, maybe a little dangerous, but logically plausible. Again, do not try this at home.
Okay, what's the pitch?
I call this the toll booth arbitrage.
I'm listening.
The pitch is long Triumph Financial, TFIN, and short traditional asset-heavy trucking carriers.
Ooh, a pairs trade. You're betting on the tech against the actual trucks. Walk me through the logic.
So the setup is this. We know the freight recession is flatlining. Bad news for carriers. Their rate per mile is down, but their costs, fuel, insurance, engines are still sky high.
Right. The curse of being asset heavy. You own the trucks, you own the depreciation, whether they're moving or not. High fixed costs.
Exactly. Now look at Triumph. They're the toll booth. They just proved they can raise their toll. That fee percentage going from 31% to 35%, even when traffic is slow, they're asset light.
So you're betting on their pricing power versus the carrier's complete lack of leverage.
I am betting on margin expansion via tech versus operating leverage via volume. TFIN is aiming for 40-50% margins with AI. The carriers are just praying for a boom that management says isn't coming this year.
It's a compelling argument. You're basically saying, I don't care if the market recovers, I care who controls the money. If it's flat, carriers blade cash. But Triumph grows earnings by squeezing more out of every transaction.
So what's the flaw? What's the widowmaker risk on this trade?
It's credit. That's the one thing that connects the toll booth to the road. If the freight recession gets worse, not just flat, but deep recession truckers don't just stop driving, they go bankrupt.
And if they go bankrupt, Triumph is left holding the empty bag, the invoice.
Exactly. Triumph had negative credit losses this quarter, which was a nice tailwind. But if we see a wave of carrier bankruptcies, TFIN's credit losses could spike. The toll booth closes if there are no cars left on the road.
That is a fair assessment. It's a bet on the network surviving the purge. But seeing J.B. Hunt sign up, that suggests the smart money is betting on the network.
It suggests the big players realize they can't fight the platform. They're choosing to just pay the toll.
They are. And that is the wrap on Triumph Financial. To recap, huge beat, 777 EPS. The stock sold off on recession fears and the ending on LoadPay.
But those underlying metrics, that fee percentage jumping to 35% and the factoring margins hitting 32%, they suggest the core business is stronger than the stock price reflects.
Management says they are keeping the main things the main things. The market is just waiting to see if those main things can make money in a flat economy.
It's a real show-me story for 2026.
Absolutely. Thanks for listening to Talk Tickers. We'll catch you on the next print. Stay warm out there.